Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In today's episode, I'll explain something that's usually considered very hard to understand for persons that have never heard about it, and it's called options. So we've already spoken about bonds, we've already spoken about stocks, but if you have any brokerage account, you've probably received some emails that are promoting options, and they say something like, you don't have to be a professional to be trading options, and you can start making money with options, but what really are options? Options are a type of security that's called a derivative security. And it's called like this because its value depends on the values of something that's underlying it. And the name comes because when you have an option, you literally have an option to either buy or sell, as we're going to see it, but this is not an obligation. What you're buying, it's like a decision. Think about it as when you're buying probably tickets from an airline and they tell you, do you want to freeze this price? You can pay only $2 and the price will freeze for you so you can buy later. This is a little bit how it works. So you're buying the opportunity, let's say, to buy that option in the future. But if then the price went lower, you are not forced to buy it. It was just an option that you have, and you may either take it or not take it. But the thing is, if you do take the option to buy or sell, the person on the other side of the equation has the obligation to fulfill it as soon as you exercise it. So let's talk about important concepts here, and I'll try to give you my hacks so you don't get confused with all the jargon, because prepare, it's going to be lots of new words that may sound confusing, but they're not going to be. So first, we may have call options. Call options are going to be when you have an option to buy an asset. So the ticket that I was talking about, this would technically be like a call option. I have the option, for example, to buy a Google stock, so Alphabet, at $190 in 1 year. Would I take it or won't I take it? So here I just said important things. I said the expiration date. I also said the strike price or the exercise price, which is 190 in my case. I said the price that you'd be willing to do that option for. And then I also mentioned my underlying asset, that would be my share of Google. And this wouldn't come for free, obviously. You would have to pay some small fee for this. It can be small if the option doesn't seem like it's going to be very profitable or very let's say real, probabilistically. But then if it's not, it may cost you even like 1 cent. So for example, that one from Google or Apple or Meta stock, you can go into places like Yahoo Finance and search for the options. How much are they selling individually? And that would be the price of the call option. So call is going to be related to buying. But of course, here you have two parts. You may have a long position, and this is going to be one of my hacks, the first hack. Long, it's always going to be the person with the option, not the obligation. So if you're long, you can have the option to buy. And if you are with the short position in the call, it would be your obligation to sell if the person decides to exercise, which means to take the option. So this is only a bit more jargon. So if I decide to buy it, why would I do it? First, because the stock price is actually higher than my strike price, right? If I had said I'm going to buy Google at 190 and it's costing $195, of course I will take it. I'm earning $5. So that means the option is in the money because my cash flow would be positive. If it's not very good, the option, I would be out the money. And this would be because my cash flow would be negative if I exercise the option. And in that case, I probably wouldn't even have, or I wouldn't take that option to buy it. And if it's the same as if time arrives and in 1 year, Google stock is worth 190, I would just say I'm at the money. I didn't gain anything, I didn't lose anything. But this would only be related to the strike price, which is the number I'm betting on, compared to the actual stock price. And this is going to give us two important values. The first value would be the intrinsic value of the call option. The intrinsic value is going to be the maximum between 0, which would be what I get if I don't take the option, but it could also be the price of the stock, the real price, minus my strike price, the one I was betting on. So in Google's case, for example, if I decided to do the option and it was costing $195 and my strike price was $190, I would get 5. So here, my intrinsic value would be 5. And then the time value is how you get the difference between the call price, which is usually what I had to pay beforehand, and then minus the intrinsic value. It's going to be the difference between these two, because the intrinsic value does not necessarily mean all the money that you had from that option. It's just going to mean the difference between the stock price and the strike price. But here, the time value would be how much was the value that you paid for this when you were betting for it. And this, now that you know how it works, it starts making sense. You can remember my hacks, so long call, it's going to be always the person that has the option to buy. And so my value, or let's say my cash flows, if I had a long call position and I was the buyer, would always start with like a 0 value or the negative value, let's say, because I paid a little bit of the option price. But then my maximum price is infinity. What if Google got out something extremely interesting and then the stock price rose to 300? That would be one of the possibilities. So your maximum value is very high. And your minimum value that you earned, or well, that you lost, would technically only be what you bought for the call option. If you didn't take the option, then it's your loss. But then if you decide to take it, you could get very high wins on this option. Let's look at the other side though. What happens to the seller? The seller starts with a very little positive value. So let's say 10 cents. Because they were receiving the money that the buyer was doing. But now, if the option was exercised, whatever I, as a buyer, gain, the seller's going to lose. So this is a zero-sum game. Whatever one person takes, it takes it away from the other person. So this one can have a minimum value that is very big. Or well, at least it can open to be potentially very big. Because imagine that you were the person that was forced to sell Google when it's at 300 and you only had to sell it at 190. Then your losses would be tremendous. So the minimum value of the short call, it's going to be very low, and that's why it's going to be sloping down. While the maximum value, it's only going to be the option price, so the call price in this case. This is one of the sides that we can look at, and if you were looking at the video while I was talking, you were able to see these graphs. But now let's look at the other possible option that you have. And this one's called a put option. So put option is going to be the opposite. It's going to be related to selling. So you have the option to sell. And again, I told you one of my hacks is long position will always mean you have the possibility, the option, not the obligation. Obligations are short. You as a long person have the option. So that's one of the tricks I used for remembering this. Long always gives you the option. So on the seller side, you'll get the option to share, same thing. One share for a strike price on an expiration date at one specific price of the put option. Then, if I decide to take the option or not, the buyer has to take it. The buyer side has an obligation to buy, and this is going to be a short put position. And here, it's going to be kind of the opposite. When would I like to sell? I would like to sell if the stock is not going higher, but lower. So let's imagine, same situation, same numbers. I want to sell Google at 190 in 1 year. If in 1 year, the stock costs 200, I'm not going to sell someone for 190. I would be losing. But what if the stock went down and it's only in 150? I could sell it for 190 and make a lot of profit. So here, you would make profit if your stock is smaller actually than your strike price. And that would mean that you have a position that's in the money, similar to what I told you, because your cash flow now would be positive. If the stock option is higher than the strike price, you wouldn't take the option. That would be 0, let's say, because if you take it, your cash flow would be negative. And then lastly, if it's the same, so strike price equals stock price, then you would also be at the money. So the thing here that we have to understand is that put options are going to behave kind of the other way around than calls, but in the put options, the long put starts with a high amount, and then it starts going down until the minimum value can be the strike price minus the stock price. That until the minimum it can reach would be the option price, but the maximum it could reach would be the strike price minus the stock price. This, if you were watching closely, are graphs that are inverted from the calls. So when would you decide if you do a call option or a put option? Basically, as you already been hearing, options are a bit more like betting on the market. It doesn't feel as investing. So if you're betting on the stock price to fall and you're bearish on that company, you can either have a short call or a long put. Why is this? Because first, with the short call, you would have the obligation to sell. So you would get rid of it if it gets low. But then in the long put, you would have the option to sell. So also you're betting for it to go down. If you want to sell, you are bearish on that stock. Now, of course, if you're betting to buy that stock, you should be bullish about it. You should believe that this stock is going to go up. And so if this is the case, you should either have a long call or a short put. So long calls would give you the option to buy at a specific price. If I believe it's going to skyrocket a stock, I could have a long call because it will give me the option to buy low. Or also, the short put will give me the obligation to buy in case it's exercised. So you have to remember all of these terms: short, long, call, and put. How do you do it? One of the hacks that my professor gave to me is that call is related to buying, because in the alphabet you see A, B, C. B, it's buy, C, call. They're always going to be short. And on the other side, the put is going to be for selling. Also because S and P are closer in the alphabet. So put options are the option to sell. Call options are the option to buy. And my other hack would be, how do you know the short and long? Long will always be your option. Short will always be your obligation. If you're still confused, look at this table and take a screenshot of it, or check out my post on LinkedIn about this topic, in which I'll leave in the comments. And I'll see you next week so we can talk about how do we value one of these options.